From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Good afternoon, this is the COB. It's great to have your company. My name is Kyle Rodder, and it's been another poor day for the local market, to say the least. Let's get a look at it now. The CBO 200 finishing what is down by 0.54%. So just off the day's lows, but when it comes to the ASX 200, it is just above that 7,000 level. In fact, it has closed cash trade at 7,008, having tested 7,000 on the dot, and I would imagine that's a pretty key technical level, psychological level for a lot of investors out there. We'll have to keep an eye on, obviously, how the post-market auction wraps up as to whether, well, we potentially close below there. It would be fairly meaningful if we do, and it does take the last week of losses to 2.7% now. The last 3 days or so to about 3%. So some weakness there in equities, to say the least. But a few themes that we were tackling throughout the day and that did define the day. Buyers. Well, perhaps that is what we're seeing right now, a real absence of buyers to step in to defend this market right now, and sellers seemingly in control. Deflation nation, we'll get onto that a little bit with my guest, but China's inflation figures showing a continued downward trend, really in stark contrast to what's happening in the rest of the world, where central banks are having to slam the brakes to try and cool runaway inflation. And land of leisure, we'll talk about Ardent's results in just a moment, but beating expectations, showing that travel and leisure spend is perhaps resilient and, well, indicative of a resilient consumer as well. Time will tell, but it was certainly a good day's trade for Ardent Leisure. Let's get to some of that stock news now, and actually straight into that story, because Ardent Leisure's full-year group revenue rose to just shy of $84 million, with the company expecting to break even in the second half of 2023 and deliver its first positive full-year earnings result. This is despite flagging short-term macroeconomic headwinds, leading to more moderate growth in the near term. In the banking space, meanwhile, big moves over at Westpac. The Linda has appointed RBA Assistant Governor Lucy Ellis to be its chief economist. Alice will replace, of course, Bill Evans, who's been the chief economist since 1991. She'll start the role on October 9. And last of the big news stories of the day from a corporate perspective, GQG Partners. It has reported a boost to funds under management in the month of June, coming in just over $5.5 billion US. Total FUM was up to around $104 billion US. Let's zoom in on some areas of the market now that were in focus, starting with the metals and mining sector. A fairly mixed picture. In fact, you could say that it was mostly a red one. The big three, BHP, Rio Tinto and Fortescue Metals, all falling, and, well, the sell-off gathering steam throughout the day's trade. But the gold miners were higher. Newcrest Mining up by 1.2%. A lot of that set up by a strong lead from US gold miners after what was those mixed US non-farm payroll figures, which seemed to weigh on the US dollar and boost the price of gold. Also in focus was the tech sector, also delivering a mixed day's trade. However, Xero and WiseTech bouncing back. Block also edging back towards that $100 per share level. Meanwhile, Computershare and Altium lower. The sector overall, however, finishing in the green. And consumer staples, also a weak part of the market today, down 0.95%. In fact, it was the biggest weight on the market overall from a sectoral point of view, and you can see Woolworths and Coles there, both off. Metcash too, after what was a reasonable week last week. There was some news coming out from the company that was treated reasonably favourably by investors. It's down 0.5% for this Monday. And the stock of the day was Westpac. We had David Lane and Daniel Ortizi join us to chat with David Koch about, well, whether they be a buyer of Westpac here.
But as far as an investment's concerned, we like Westpac at current levels. We've got an accumulate recommendation on it. It's actually trading at pretty good fundamentals, PE of about 10 times and a dividend yield of 6.9%. Fully franked. So the gross yield is nearly 10% on Westpac. So definitely good from a yield perspective. And generally, we do find that banks in rising interest rate environments make more money.
We're certainly, quite cautious banking as a whole, probably because we're coming off a peak in margins and a peak in profitability. So they are trading on higher yields, but I think that's the market kind of saying, we're anticipating that to potentially fall, if not be very stable for the next few years. So really X growth. One thing that we've been focusing on quite heavily is really the rollover from the RBA's TFF, the term funding facility, at that very low rate. And I think Westpac's probably one of the more well-progressed banks in refinancing that. So I think there are probably reasons to be, relatively positive on Westpac out of the big four, but keep in mind, that they're talking up the cost out program. Very difficult to manage when you've got, rising cost inflation in their P&L base. So probably a few things to be cautious about, but we'd be happy to hold it here. Probably not enough value at the moment for us to be buyers.
Okay, so perhaps not a screaming endorsement for Westpac from those two gentlemen. It is an argument that I've heard for a little while now that it is trading at a slightly bigger discount to its other rivals, but hasn't really seemed to be able to close that gap, at least not yet. Time will tell, but a little bit mixed there. Certainly won't be going to the investment committee. But well, let's get a wrap up on the day's action now. For that, Josh Gilbert from eToro joins me. Josh, good to see you there. It looks like the market really can't catch a break at the moment. What is it, a fourth day of losses now?
Yeah, well, exactly that, Carl, coming off a pretty poor week last week. I think it was the worst week we had since September, and that sort of was a little bit surprising given that we had a bit of optimism early in the week from the RBA, obviously keeping rates on hold. I think the economic data that we sort of had throughout the week was showing signs that, especially in the US, that we're seeing that economy weaken, and particularly locally as well, that although we had that sort of pause earlier in the week, investors were still sort of believing that, the RBA were going to keep their foot on the gas. And it was that sort of quick change in focus that, okay, we've got a pause, but it's probably a skip. We're still going to see more hikes from here. And I think, as I say, that sort of, digestion of that economic data, especially, earlier in the week, we had the jobs data, sort of initial jobless claims, and then obviously later in the week, the non-farm payrolls backing sort of that data up, showing that we are starting to see the economy slowing after, what has in the US been a pretty resilient economy all in all. But yeah, the ASX can't sort of really seem to sort of catch a break at the moment. I think until we see that real pivot from the RBA, we may still see the market come under a little bit of pressure for now.
Of course, it all sort of ties back into that global theme as to, where rates are going and how long they'll be there. The jobs data on Friday night out of the United States, something for everyone, but certainly seems to be telling us that the Fed is going to at least stay the course for now.
Yeah, I think that the jobs number was mixed. I think that's definitely something to take away from it. Bit of a mixed blessing, if you like. I think a strong jobs market and wages rising above inflation are obviously helping the consumer, the economy, and obviously going into earnings season, company profits as well, which is really important. But it's also not great for those bearish investors who are calling for sort of a recession as well, because we saw a slowdown in the jobs number that we had, but it was still a pretty strong number all in all. And I think it will keep the Fed on the front foot for hiking. And I think it will need to see clearer evidence of a broader cooling in the labor market, which will obviously help feed into sort of lower underlying inflation. I think that's also the case that we're going to get here locally as well. That jobs market is still a headache for Governor Lowe, and it's the same for Jerome Powell. Wages are still a big worry for both of those. And I think that markets in the US, they did react a little bit with some relief, because I think it was braced for a stronger report, especially after the ADP, private payrolls, the services PMI strength as well. But I think all in all, yeah, all the data that we've had from the US in the last sort of couple of weeks is pointing to another hike coming from the Federal Reserve at the end of the month, and rates staying a little bit higher for longer for now.
Yeah, absolutely. Seems to be the narrative for the moment. But we can talk almost the exact opposite for China's policymakers. The inflation figures there today fairly soft. So I guess we're all waiting for maybe a little bit more support from the likes of the PBOC and the central government over there.
Yeah, absolutely. That reading out of China today is just sort of one of many of the economic readings that we had from China in recent months. It's just sort of more confirmation that sort of economic recovery is faltering. And I think it just adds to what is, as I say, a mountain of evidence now that's in place for officials, I think, to sort of roll out further stimulus measures. I think China has continued to state, though, that I think, policy is going to be, it's going to be targeted. It's going to be well coordinated. It's not going to be a flood. I think they're going to sort of slowly turn on those taps. They're not going to flood this market. And that sort of drove down expectations for, a large stimulus package coming in. Obviously, we're looking for maybe targeted stimulus in say, the real estate market. But these inflation numbers also, feed the fear of deflation. Consumers and businesses are obviously continuing to hold back on spending with the expectations that prices are obviously going to fall further. And then that obviously raises concerns of price spirals as well. But I think, the data that we got from China today, I think it just sets that scene for further easing from the PBOC. And I think that could be good news for equities. That they've really struggled so far in 2023. The Hang Seng has well underperformed global equities. And I think, if we do see more action from the PBOC, as we had, I think it was at the end of June, where they cut some key lending rates, alongside what now looks to be a better regulatory environment, especially for those internet stocks. We saw on Friday that there could be news that they're sort of wrapping up their long-winded, look into these sort of Chinese tech stocks. And I think that could very much put Chinese tech back on investors' radars, because it takes a huge overhang away from those stocks. Again, there were some big fines handed out, especially for the likes of Ant Group, obviously, which is under the roof of Alibaba. But importantly, it takes away some uncertainty there for investors. So I think, some more easing from the PBOC mixed in with that good news from the regulatory crackdown, I think makes a nice little mix there for those contrarian investors, particularly, that are looking at the Chinese tech scene that has well underperformed against sort of US tech, and just broader, even in European tech and obviously Australian tech as well. But those valuations are obviously far more attractive than what you're getting in the US.
Yeah, incredibly compressed, have been for some time. So perhaps one for the intrepid investor out there to make a foray into Chinese equities right now. Last but not least, it's hard to ignore the fact that we do have US earnings season basically kicking off at the end of the week. We have had Nike and a few others rolling through already. But I suppose you'd be prepping yourself for obviously another big reporting period.
Yeah, some more early mornings back on the cards again. But no, I think this Q2 earnings is obviously going to be really important. We've obviously coming off the back of a huge 6 months to sort of start the year, especially from the NASDAQ. We've got bank earnings obviously coming through this week. They'll be obviously key to watch, especially on the back of, the start of the year when we had those banking issues. Net interest income has likely peaked across the bank. So earnings are obviously going to be in key focus. Deposit inflows, deposit outflows, loan growth, how is that holding up? That's going to really give us a nice signal in terms of the economy as well. Looking to obviously those consumer names as well at the back end of the week. We've got Pepsi coming through. Nike obviously really struggled last week as well, so that'll be another key one. I think though, for me, Tesla's going to be a sort of a real focal point, I think, of earnings season, as well as something like Nvidia. Those two names are going to be the focal point for me. Tesla, just particularly because, record deliveries in the quarter, but that is obviously going to put pressure on margins after obviously cutting prices at the start of the year. So margins are going to be really in focus. Consensus is for 20% gross margins on the automotive side. Anything below that, I think the stock's going to come under pressure, especially when your share price is up 127% in the first 6 months of the year. And then obviously Nvidia obviously gave that blowout outlook for the second quarter. Obviously a big thanks to sort of AI. But if they don't live up to those expectations, then we're definitely going to see some weakness there, which is, their shares have obviously gained more than 150% year to date. So I think the key point here is that there's no margin for error for any of these tech stocks or any stocks that have significantly gained so far this year.
It does seem that the bar is set reasonably high, or at least a big set of optimistic assumptions being sort of baked in, perhaps. But time will tell. Josh, really appreciate you getting us across what we need to know. Josh Gilbert from eToro. We'll talk soon.
Thanks, Carl. See you, mate.
Okay, well, let's get across the leaders and laggards now, starting off with the leaders, and a lot of gold, as you can see on your screen. So take that for what you will. There's certainly that weaker US dollar story that emerged after the non-farm payrolls figures. maybe something more to it with this risk aversion in the market. I don't know. But nevertheless, if you are exposed to gold, at least today, you're that slight bit better off. Let's get to the laggards though. Looking at, well, Tabcorp down 3.3%, PointsBet as well. So actually, let's just have a look at that because there's a thematic for you. Must be some news around regulation there that we haven't quite picked up on yet. And if you just deal with my chatter for a moment, I'm just going to see if there's anything there that we can find that is behind the move in both of those names. I'll have to keep an eye on for it, out for it, because I can't really see it off the top of my screen. It does seem relevant though, so I'll keep digging around. Tabcorp falls. Listen, I'll get back to you if I can find something, but for the time being, it would seem that there's something rather relevant, obviously, to the gaming space there. Magellan still falling after reporting some fund outflows last week and a broker downgrade today. Santa Barbara bucking the trend when it comes to the gold space. South 32 also down 2.6%. And I can see here possible gambling restrictions is maybe the story when it comes to those gaming stocks. To the small cap leaders and laggards now. Across the screen, Cobalt Blue up by 17.7%. Ardent Leisure, we did speak about that a little earlier, just about the much better than expected results, so up by 13.5% by the end of the day's trade. CTI Logistics also up 11%, so is Pacific Edge. Going to the laggards now for the small caps. OneView Healthcare down 25%, a fairly significant drop. European Lithium also down 14%, with Next Ed 2 off by 13.5%. Let's get to what's on overnight now, just very quickly. Not too much news, but we are going to get a lot of colour this week and going into the next few weeks before the Fed's next decision, which is the back end of this month, from Fed speakers. And well, the minutes last week seemed to speak of a certain level of division amongst board members about the path forward for interest rates. So some of these comments will be crucial as the market tries to decipher whether the Fed will go again in July, and more crucially, whether it has one or two more hikes left up its sleeve. Could even be more, but it would seem that that is the debate at the moment. We've also got Bank of England Governor Bailey speaking. Obviously, his job has been rather difficult, scrutiny on him rather high, especially as we go into what is actually some UK employment figures tomorrow night, but we'll have to wait another 24 hours until they come through. And let's get a look at the day ahead tomorrow. Westpac consumer sentiment and NAB business confidence. So it's all going to be about how you're feeling out there. One would assume that not so good, although maybe we'll get a bit of a boost in those readings off the back of the RBA's decision to pause interest rates earlier on in the month. Okay, well, we may as well leave it there for another day. Remember, you can catch up on all the news and interviews on your website and app. Otherwise, we look forward to seeing you tomorrow morning.